What if I told you that a single event changed everything I believed about silver in 2026? Not a rumor, not a headline designed to grab attention, a real event, one that forced me to re-examine the data, the markets, the global economy, and the future of precious metals. For years, investors have focused on the same indicators, the same forecasts, and the same expectations, but every so often, something happens that shifts the entire landscape. Today, I'm going to reveal the event that completely changed my silver prediction for 2026, why it matters more than most people realize, and what it could mean for investors who are paying attention before the rest of the world catches on. The opportunity may be far bigger than anyone expects, and the clock may already be ticking. For years, silver investors have been trained to watch the same indicators. They monitor inflation reports, central bank announcements, interest rate decisions, employment data, manufacturing activity, and the performance of gold. These factors have traditionally shaped expectations for where silver might move next. They remain important, but every so often a moment arrives that changes the entire framework through which a market should be viewed. It is not merely another piece of information added to an existing model. It is a development that forces the model itself to be reconsidered. In my view, that is exactly what happened with the event that completely changed my outlook for silver in 2026. When analyzing precious metals, the biggest mistake investors make is assuming the future will resemble the past. Human beings naturally project familiar patterns forward. If silver spent years moving within a particular range, people expect it to continue behaving in a similar way. If a certain relationship between supply, demand, and price existed for decades, investors assume that relationship will remain stable. Markets, however, are not static systems. They evolve. They react to technological changes, geopolitical developments, financial pressures, and shifts in investor psychology. Occasionally, multiple forces converge at the same time, creating a new reality that makes old assumptions increasingly unreliable. What caught my attention was not simply the event itself, but the chain reaction it set in motion. Many market participants saw the headline and moved on. They viewed it as another temporary development that would eventually fade into the background. I approached it differently. I asked what this event would mean not just today, but 3 years from now, 5 years from now, and even a decade into the future. Once that process began, the implications became impossible to ignore. The first thing I noticed was that this event exposed a vulnerability that had been building quietly beneath the surface for years. Most people focus on visible market activity. They watch prices move up and down each day. They pay attention to news stories that dominate financial media. Yet the most important developments often occur behind the scenes. Structural changes can take years to develop before suddenly becoming obvious to everyone. By the time the majority recognizes them, much of the opportunity has already passed. Silver occupies a unique position in the global economy. Unlike many commodities, it serves two very different functions simultaneously. It is both a monetary metal and an industrial metal. Investors buy it as a store of value, a hedge against uncertainty, and a form of wealth preservation. At the same time, manufacturers require it for countless industrial applications. This dual role creates dynamics that are far more complex than those affecting most other commodities. The event that changed my prediction forced me to examine that industrial side more closely than ever before. What I discovered was that demand growth was no longer following historical patterns. Instead, it was accelerating in ways that many traditional forecasting models failed to capture. Entire industries were becoming increasingly dependent on silver. Technologies that once represented a small portion of demand were evolving into major consumption drivers. The scale of this transformation was difficult to appreciate until all the pieces were examined together. As I dug deeper, another realization emerged. Supply was not responding the way many analysts expected. In theory, rising demand should encourage increased production. Higher prices create incentives for mining companies to expand operations and develop new projects. The reality, however, is far more complicated. Mining is capital-intensive, time-consuming, and subject to numerous economic and political constraints. New discoveries are becoming harder to find. Development timelines continue to lengthen. Regulatory challenges remain significant. The industry cannot simply flip a switch and produce dramatically more silver overnight. This mismatch between future demand and future supply became increasingly important after the event occurred. What had previously looked manageable began to appear much more serious. Forecasts that once seemed reasonable suddenly looked too conservative. Assumptions that had guided market expectations for years no longer appeared sufficient. One of the most fascinating aspects of financial markets is that transformative events rarely announce themselves as transformative events. History provides countless examples. When major trends first emerge, they often appear insignificant. The significance becomes obvious only in hindsight. Investors look back years later and say the signs were there all along. The challenge is recognizing those signs while they are still developing. In this case, the event acted as a catalyst. It did not create every underlying trend. Many of those trends were already in motion. What it did was accelerate them. It brought existing pressures into sharper focus. It highlighted vulnerabilities that had previously been overlooked. It forced investors, analysts, and industry participants to confront realities that were becoming increasingly difficult to ignore. Another reason this event captured my attention was its global nature. Precious metals markets do not operate in isolation. They are influenced by developments occurring across continents. Economic policies in one region can affect investment flows in another. Industrial growth in one country can impact commodity demand worldwide. Financial uncertainty in one market can drive capital toward alternative assets elsewhere. The event demonstrated just how interconnected the modern economy has become. It revealed relationships between sectors that many investors rarely consider. Actions occurring thousands of miles away were influencing decisions made by manufacturers, governments, financial institutions, and individual investors. Once those connections became visible, the potential implications for silver appeared far larger than initially understood. Investor psychology also played an important role. Markets are driven not only by fundamentals but by perception. Expectations influence behavior. Behavior influences prices. Prices influence expectations. This feedback loop can create powerful trends that persist far longer than many anticipate. Before the event, a significant portion of the market remained skeptical about silver's long-term prospects. Many investors viewed it as perpetually undervalued but chronically disappointing. They remembered previous rallies that failed to meet expectations. They remembered periods of volatility that tested patience. As a result, enthusiasm remained relatively subdued despite favorable underlying conditions. The event began to change that narrative. It provided a compelling reason for investors to reassess existing assumptions. Questions that had previously received little attention suddenly became topics of serious discussion. Analysts started revisiting projections. Institutional investors began reevaluating exposure. Market participants who had largely ignored silver found themselves paying closer attention. One lesson I have learned throughout decades of studying markets is that narratives matter. Not because narratives create reality, but because they influence how reality is interpreted. When a market transitions from being ignored to being noticed, significant changes can occur. Capital flows shift, media coverage increases, investor participation expands, momentum builds. What intrigued me most was that this shift in perception appeared to be occurring alongside genuine fundamental improvements. Too often, markets become driven by excitement unsupported by reality. Speculative enthusiasm can create temporary price increases that eventually collapse. In this situation, however, the developing narrative appeared increasingly aligned with underlying economic conditions. The more research I conducted, the more convinced I became that many existing silver forecasts underestimated the magnitude of potential change. Analysts frequently rely on historical relationships when constructing projections. While history provides valuable context, it can also create blind spots. If future conditions differ significantly from past conditions, historical averages may become less useful. The event highlighted exactly that possibility. It suggested that silver might be entering a period unlike anything experienced in recent decades. If so, traditional valuation methods could require adjustment. Expectations based on previous cycles might prove inadequate. Price targets that once seemed ambitious could eventually appear conservative. Of course, responsible analysis requires caution. Markets are inherently uncertain. No prediction is guaranteed. Numerous variables can influence outcomes. Economic growth can slow. Technological developments can evolve differently than expected. Government policies can change. Investor sentiment can shift unexpectedly. Yet uncertainty should not prevent us from recognizing meaningful developments when they occur. The goal is not achieving perfect certainty. The goal is identifying probabilities and understanding how those probabilities evolve over time. The event altered those probabilities in a significant way. Another important consideration involves timing. Markets rarely move in straight lines. Even when long-term trends are favorable, short-term volatility remains inevitable. Prices can experience substantial fluctuations. Investor sentiment can swing rapidly between optimism and pessimism. Temporary setbacks often occur even within powerful bull markets. The event did not convince me that silver would immediately surge without interruption. Instead, it convinced me that the long-term trajectory deserved reassessment. It shifted my perspective from viewing certain outcomes as possible to viewing them as increasingly probable. That distinction matters because investment decisions are ultimately based on probabilities rather than certainties. As more information became available following the event, the evidence continued to support this evolving view. Data from multiple sources pointed toward the same conclusion. Industrial demand trends remained strong. Supply challenges persisted. Strategic interest in precious metals continued growing. Broader economic conditions reinforced the attractiveness of hard assets. What made the situation particularly compelling was that these factors were not operating independently. They were reinforcing one another. Increased demand highlighted supply limitations. Supply limitations attracted investor attention. Investor attention influenced market sentiment. Market sentiment encouraged further analysis of underlying fundamentals. This interconnected process often characterizes major market transitions. Change does not occur because of a single factor alone. It occurs because multiple factors align simultaneously. Each reinforces the others, creating momentum that becomes increasingly difficult to reverse. Looking back, it is easy to see why the event had such a profound impact on my thinking. It served as a lens through which broader trends became visible. It transformed isolated data points into a coherent narrative. It connected developments that had previously appeared unrelated. Most importantly, it challenged assumptions that many investors, analysts, and industry participants had accepted for years. The experience reinforced an important principle. Successful forecasting requires flexibility. Analysts must be willing to update their views when new information emerges. Clinging to outdated assumptions simply because they were once reasonable can be costly. Markets reward those who adapt and punish those who remain anchored to the past. The event reminded me that the most significant opportunities often emerge during periods of transition. They arise when conventional wisdom begins to lose relevance but before a new consensus has fully formed. During those moments, careful analysis can provide valuable insights that are not yet widely recognized. Every major bull market has a point where perception begins to change. There is a moment when a market shifts from being overlooked to being increasingly difficult to ignore. The transition is rarely obvious in real time. It unfolds gradually, then suddenly. The event that changed my 2026 silver prediction appears to be one of those moments, a development that forced a reevaluation of assumptions, highlighted emerging realities, revealed structural pressures, exposed growing imbalances, accelerated existing trends, attracted new attention, reshaped expectations, challenged traditional forecasts, altered long-term probabilities, and transformed the way I view silver's future potential. One of the biggest mistakes investors make in any market is assuming that yesterday's formulas will continue to explain tomorrow's outcomes. Financial history is filled with examples of people relying on models that worked perfectly for years, only to discover that the environment had changed and the rules they trusted no longer applied. Silver is no exception. For decades, analysts built forecasts using familiar indicators, historical relationships, and long-established assumptions. These methods often provided useful guidance, but there comes a point when a market evolves so dramatically that traditional forecasting frameworks begin to lose their effectiveness. That is why I believe many conventional silver forecasts have become increasingly obsolete. To understand why this matters, it is important to examine How most silver predictions are created. Analysts generally look at historical price cycles, inflation trends, interest rates, economic growth, mining production, and investor demand. They compare current conditions with previous periods and attempt to estimate future outcomes based on patterns observed in the past. There is nothing inherently wrong with this approach. Historical analysis remains an essential part of market research. The problem emerges when the future starts to differ significantly from the conditions that produced those historical patterns. Silver today is not operating in the same world it occupied 20 years ago. It is not even operating in the same world it occupied 10 years ago. The global economy has changed. Technology has changed. Energy systems have changed. Geopolitical relationships have changed. Manufacturing priorities have changed. Investment behavior has changed. Yet many forecasting models continue to treat silver as though it exists within the same framework that defined earlier market cycles. Traditional forecasts often assume that demand growth will remain relatively predictable. Historically, silver demand moved within ranges that analysts could estimate with reasonable confidence. Industrial use expanded gradually. Investment demand fluctuated based on economic conditions. Supply adjusted over time. Price movements reflected these interacting variables. While volatility certainly existed, the broader structure remained familiar enough for many forecasting models to function effectively. The challenge today is that demand dynamics are evolving faster than those models were designed to handle. Entire industries are becoming more dependent on silver than they were in previous decades. New technologies continue emerging. Existing technologies continue expanding. Applications that once represented a relatively small portion of overall consumption are becoming increasingly significant. As a result, historical demand patterns may no longer provide a reliable guide to future demand levels. Many traditional forecasts underestimate the speed at which structural changes can influence commodity markets. Analysts frequently assume that major transformations occur gradually. In reality, adoption curves often accelerate unexpectedly. Technologies can spend years developing with little apparent impact before suddenly reaching critical mass. Once that threshold is crossed, demand growth can expand far more rapidly than conventional models anticipate. Another issue involves the way many forecasts treat supply. Traditional models often assume that higher prices will eventually encourage sufficient production increases to balance the market. This assumption made sense during periods when mining companies could respond relatively quickly to favorable conditions. However, the modern mining industry faces challenges that are significantly different from those of previous generations. Discovering new deposits has become increasingly difficult. Developing new projects requires substantial capital. Environmental regulations have become more complex. Political risks remain significant in many resource-rich regions. Infrastructure requirements continue growing. Permitting processes often take years. These realities mean that supply responses may occur much more slowly than historical models suggest. When analysts rely heavily on historical supply behavior, they risk underestimating future constraints. They assume that production growth will emerge when needed because that is what happened in previous cycles. Yet if the industry's ability to expand has fundamentally changed, those assumptions may no longer hold true. Forecasts built on outdated supply expectations can therefore underestimate potential market tightness. Another factor contributing to obsolete forecasting methods is the growing disconnect between paper markets and physical markets. For many years, silver prices were heavily influenced by trading activity in financial markets. Futures contracts, institutional positioning, speculative flows, and macroeconomic sentiment often dominated short-term price action. Analysts naturally incorporated these influences into their forecasts. While financial market activity remains important, physical demand is becoming increasingly difficult to ignore. As industrial consumption grows and strategic interest in physical metal expands, the relationship between paper trading and physical availability may evolve. Forecasting models that focus primarily on financial variables risk overlooking developments occurring within the physical market itself. Investor behavior has also changed in ways that traditional forecasts often fail to capture. Modern investors have access to information research and communication tools that previous generations could scarcely imagine. News spreads instantly. Market narratives can develop rapidly. Investment themes can attract global attention within days rather than months. This acceleration of information flow creates dynamics that historical models struggle to incorporate. Investor sentiment can shift faster than ever before. Capital can move across markets with unprecedented speed. Trends can gain momentum rapidly once a compelling narrative emerges. Forecasts based solely on historical investor behavior may therefore underestimate the potential for dramatic market movements. The role of central banks and monetary policy presents another challenge. Traditional silver forecasting models often rely on established relationships between precious metals and interest rates. Generally speaking, rising interest rates are considered negative for precious metals because they increase the attractiveness of income-producing assets.